Okay, we're right on top of the hour. I want to welcome everybody to today's webinar, Expert Tips on Buying or Selling a Business, and our distinguished panelist, Mr. Tommy Thompson. I'll turn it over to you, Tommy, and thank you for joining us today.
Thanks very much, Chris. Good afternoon, everybody, and welcome to this NMSBDC seminar. I'm Tommy Thompson, as that says. I'm a certified SCORE member and a retired CPA and ABV. ABV stands for Accredited in Business Valuation. That's my technical specialty. What we want to do here is get into this. I want to acknowledge at the outset that Daryl Arnn, who is president of Arnn and Company, is the original author of many of these slides. We've edited, revised, and modified the presentation over the years, but Daryl was the first person to come up with the draft of the concept and how we're presenting it today. I just want to acknowledge his participation. He's a good guy, and thank him for his permission to use this material. Now, by way of introduction, I'm a retired CPA, but I never did things that you think CPAs do. I never did audits. I never did books. I solved problems for corporate clients as a consultant for most of my career. I've also had corporate jobs. I've been chief operating officer of a publicly traded computer hardware company. I've been chief financial officer of a venture-funded software startup. I've worked in the traditional manufacturing sector. I was director of mergers and acquisitions for a manufacturing company that made outdoor power equipment, if any of you have ever heard of the Troy-built rototiller. For the last 10 years or 15 years before I retired, I was a partner in 2 different consulting firms, the last of which was a boutique investment bank, where we helped introduce buyers and sellers and helped to facilitate the kind of transactions I'm going to be talking about today. For presentation guidance, if you haven't already, please mute your audio and set your zoom ratio to fit window. That way the presentation will fit all fully in your computer monitor screen, and that makes it easier to read some of the type that's on the slides. We'll be using the Q&A function to take questions today. If you have a question, please pop up the question box and type your question into the box as it occurs to you. Just make a quick note of which slide your question referred to, and then Chris will be watching for those questions and will interrupt me at an appropriate time so that we can answer them as the presentation continues. I'll also allow some time at the end for any of you who have final questions to write them down then. Now, the New Mexico Small Business Development Center network also wants me to provide you with this slide, which I'm not going to go into in detail, but it will be in the copy of the slides that you receive following this presentation. And these are business resources in New Mexico related to COVID-19. Yes, we know it's subsiding. Yes, we know that that many of the programs that actually provided money have now shut their doors. But these are useful guidance links and references if you're dealing with any of these types of issues. Now, today what we're going to do is talk about the training offerings and counseling assistance that come from NMSBDC. We're going to talk about our objectives for this program, and then we're going to get into the program itself, the process, the concepts, the steps, and the next steps related to buying or selling the typical small business. Now, as far as training goes, if you haven't been there already, the NMSBDC website is at nmsbdc.org. Click on the Workshop and Events tab to view the training events that they offer and the ones that are coming up. There's a schedule there, and you can sign up and register for those that appeal to you. You can also obtain one-to-one, no-cost business counseling and loan application assistance at the NMSBDC website. You go to nmsbdc.org. There's a button there for request assistance, and they'll sign you up, and you'll be able to work with one of their counselors to answer whatever questions you have. Now today, what I want to do in your mind is to raise the awareness of reasons that a deal gets done. I want to introduce the business transaction process. Like everything else, there's a process to it. I'm going to describe the major elements in that process, provide you with some basic concepts of estimating, figuring, getting a handle on a ballpark value of a business, and some of the tools that we have to help you do that. I'm going to offer a few negotiating tips. And then after you strike the business deal, the deal's not done then. After you strike the business deal, you got to still get her done. You got to get to the closing table and get all the T's crossed and the I's dotted. Or if you're a little dyslexic, the I's crossed and the T's dotted. And then we're also going to provide a little bit of time for questions. Now, I do want to urge you to write your questions down as they occur during the seminar. Otherwise, you may forget them by the end of our time. This is all going to take about an hour and 15 minutes based on prior presentations of this program. So I hope you're ready, and we're off to the races. Now, today's topics, we're going to talk about preparing to do a business deal. That's either on the buying side or the selling side. We're going to talk about the search for things to buy, businesses to buy, or the search for sellers to buy them from you. We're going to talk about a little bit about valuation and how that's affected by the tax structure of the transaction. We're going to talk a little bit about financing the purchase and give you some ideas about what you could sort of think about as a typical structure, what banks will typically do. We're going to talk about negotiating a letter of intent. That's an important part of the process, and it sets forth the business deal that you and your buyer or seller come to in the course of negotiations. We're going to talk about the whole topic of due diligence. What is it and how do you do it? And then we're going to talk about closing, right? How do you get from everything looks okay to here's the signature on the dotted line? All right. Now, first, prepare, because we want to plan, prepare, and then perform. The first thing to do is to be aware of the individual motivations that buyers and sellers have. Okay, we like to think this is a very bloodless thing. It's all about numbers. It's your required rate of return and my cash flow, or vice versa. But that's not really the truth, because everybody going into this has a motivation aside from the financials. All right, and as buyer or seller, you need to understand the motivations on the other side of the table, and you need to understand your motivations so that you can decide what's really important to you in a deal. All right. Now, for a buyer, one of their motivations might be a job. They would want to have a job. Now, in this case, they're buying a business, so they have a job. And if they don't watch out as a buyer, you could wind up buying yourself your salary as a job. We're going to talk about that and how to avoid it later. Independence is an important quality for a lot of buyers. They want to be independent of anybody else as a boss. All right. Health is important as a buyer. Maybe they've been in a very high pressure career situation for years and years or decades, and they want to do something that is a little bit better for their health, has less pressure, less stress, you name it. Also, buyers can be in existing business owners who have an interest in your business because of the opportunities for growth or synergy that will help them get bigger or more profitable. And finally, buyers could be strategic. They could want your business not because it represents an addition to their existing business, but because it represents a new direction for them, or a strategy they're pursuing to take their existing business and enhance it with what your business does, whether that's from a product or a process or a marketing standpoint. On the seller side, many sellers are looking forward to retirement. They're looking forward to reaping the fruits of their labors that may have gone on for decades. Sellers might be burnt out. Maybe they're not ready to retire, but this sure isn't what they want to keep doing. Age and health are factors too. Maybe they want to keep doing what they're doing, but they just are losing their energy level as they age, or their health is deteriorating, or there's been some sudden health crisis, either in their life or in the life of the people around them. Another motivation to sell is the fact that sellers might not have a successor. The kids don't want anything to do with it. Their general manager isn't able to step up to the plate, whether it's financially or any other way. The seller might be a one-man band and there's no successor among the workforce, if any. And what you have to do is you have to be honest about your motivations when you go into this process. What is the biggest thing you want to achieve out of this besides dollars, besides the price? Okay. What is the biggest thing you expect to do after the transaction, and how important that is that to you, and how much of a balance is it against what the business may, or in some cases may not be worth? Okay. So you have to be honest about that as you step up. Sellers, you have to start planning and preparing early. It's not too early to start 3 years before you start the actual sale process, which itself could take a year, okay, or at least 3 or 4 months. Now, in doing that, what you want to do is you want to manage the business for the maximum possible cash flow. You want to emphasize profitability throughout the business. If you can, you want to reduce capital expenditures because that improves your cash flow. You want to improve the credit standing of the business if you can, because that will help a buyer step into your shoes more easily and pick up vendor relationships more easily. The other thing you want to do is you want to continue marketing to get new customers. Your existing customer base will start to peel off and erode over time. You might have a customer an average of only 5 or 6 years. You have to keep refreshing that customer base, which means continuing to market and sell all through the process, so that you've got an ability to show increasing or at least stable cash flow for the 3 years before you actually start the sale process. That's extremely important. You can't stop marketing to new customers. Now, you have to do some housekeeping too. Do your own due diligence on your business. What does this mean? That means that you have to be able to put your hands on an ability to prove that you own everything you're going to sell. Okay? That means leases, that means deeds, that means contracts, that means vendor relationship evidence, that means customer testimonials, that means all of the things that are evidenced in your business. You have to be able to prove that you own and can transfer them to a new buyer, because they're going to do that when they get to your business. And if you have all that material already assembled, then it's much easier and quicker to move through the process. You want to work on having exceptional customer relations. You want to have your customers thinking you're the best possible business in the world for what they are buying from you. You want to have a well-trained and motivated workforce. You want workers that are happy to be with you. That doesn't necessarily mean you're paying them more than you need to, but they do need to be satisfied in their work with you. And you want them to be willing to stay, which well-trained and motivated people are likely to do. All right. You also want to identify your key people. These are the ones you're going to identify as key people to a prospective buyer, so that buyer can negotiate with them to keep them in the business. And that happens at some point in the sale process, if not at closing. You want to make sure your business equipment and your business systems are in good working order. You want to have your CPA prepare 3 to 5 years of actual financial statements, not just tax returns, but what's known as a compilation financial statement. This is a financial statement with all the schedules, the income statement, the balance sheet, the cash flow statement, and all the notes that go with those statements to make up a complete financial recitation of the business's financial condition in each of the previous 3 to 5 years. You want to invest in income taxes. And what do I mean by that? When I say that, what I mean is that you want to be sure that you have paid all the tax that's due as a result of your business operations, but no more. You don't have to overpay, but you should be sure that you've paid straightly according to the most commonly accepted positions in the law. All right. And you can work with your CPA to make sure you've done that. If you've invested in tax shelters or taken some sketchy deductions or things like that, you're going to want to identify those and be sure that you're past the audit period on those. All right. You want to be sure you're in compliance with all the other taxing authorities that you're responsible to, like, for example, the Labor Department for payroll taxes, like the GRT of Tax and Revenue Department here in New Mexico for GRT tax, for local governments, for property taxes, and any other taxing authorities that you might have. You want to clear up any litigation claims, settle them, do something to get rid of them. All right. You will have to keep records of them. You will have to disclose that litigation to a prospective buyer, but it's much easier to say it's settled and done than it is to say, well, we're working on a settlement. Okay. That scares buyers. Don't do it. Clear up any litigation claims, any claims that have actually been filed as a lawsuit, or just claims about which you've been notified that your insurance company may be working on. All right. Or anybody who's said, I hate you, I'm going to sue you because, even if a claim hasn't been filed yet. You're also going to want to check on the assignability of any leases and contracts that are vital to the business. All right. Some contracts and leases require a third party, the lessor or the contracting person or the landlord, to sign off on a transfer of the lease to a new operator. All right. That's particularly true with franchises, where the franchisor, the franchise company up at the top of the pyramid, requires that they approve any and all transfers of franchises to new owners. Now, once you've done that, you put together a package. The seller puts together what's called a confidential information memorandum. This tells the story of the business. What do we do? How long have we been doing it? Who are we doing it for? What's our target customer? It's all of the story of the business and its operations. It presents also a financial overview, usually just a summary, which would be revenue, profitability, balance sheet condition, and cash flow for the past 3 to 5 years. You want to present the business in its best light, but you don't want to misrepresent any facts, because those will come to light in due diligence, because all of that stuff gets checked in the due diligence process. Now, it's not just the seller that puts together the package, it's the buyer. You have to put together a resume that shows the seller that you have the business experience necessary to successfully operate the business, because possibly there'll be some seller financing in the deal, and they want to know that you'll be able to operate the business and pay it. The buyer wants to provide a financial statement that shows his net worth, that shows he's capable of contributing enough equity to the deal to make it work with the bank and any other financing organizations that may be involved. The buyer should also have a credit report, which provides a history of how he has paid his bills, or she, excuse me, if any of you are ladies. And also, finally, at least an outline of an operating plan that says, if I was to buy this business, here's how I would operate it generally. And the buyer wants the seller to gain confidence in that operating plan, so he gains confidence that the business will continue. All right. So both seller and buyer have to come up with a package. Buyers, sellers, especially, assemble the records, assemble the financial statements, put the tax returns, the organizational documents, key staff descriptions, contracts, leases, litigation records, corporate books, the minute books of the corporation, records and minutes of meetings, and so forth. Customer information, who's who in your customer group. All that needs to be assembled, because at some point, usually in due diligence, the buyer is going to go through all of that stuff to verify whatever assertions you've made in your confidential information memorandum or in conversations and negotiations that may have been going on. If you put it all together and put it all in one place, the buyer can go through it, or the buyer's representative, sometimes an attorney, can go through it quickly and satisfy any and all of their questions. Remember that a deal delayed is a deal betrayed. Okay? It can wind up a dead deal. And the faster you can provide everything that your prospective buyer wants, and the faster a prospective buyer gets that material, the quicker they can go through it, the faster they can satisfy their questions, and the more easily the deal proceeds. Now, pick your advisors. You don't do this yourself, okay? Now, and the reason I say this is buyers. How many businesses are you likely to buy during your life? Whether you're a serial entrepreneur or not, the number is only a couple, 3 or 4 or 5 maybe, okay? Maybe, if it's that many. Sellers, if you've spent 30 or 40 years building up a business, have you ever sold a business? Have you ever sold more than one business? Okay? You need a team on both sides of the table to help you out. First of all, you need a lawyer. Lawyers are not there to negotiate, lawyers are not there to negotiate the business deal, right? Lawyers are there to protect your interests. They may have tips about negotiations. They may have tips to offer you, but they should never be in the room when you and the buyer are negotiating a deal. I've seen more lawyers screw up more deals than you want to count, because they're always trying to interject and put in things that will protect their client's interest, but aren't necessarily part of a business negotiation. The second person you want on your team is an accountant or a CPA. They are going to tell you what the tax implications of your deal are. And they're also going to help you go through and analyze and not opine on, but give you advice on the financial statements that you see from either side, buyer or seller. All right. More importantly, the way the transaction is structured and the nature of the assets being transferred and the form in which they're transferred, whether as individual assets or as a going concern, affects how they're taxed. And you need that from a CPA to figure out how it affects your offering price and the terms. The third person you may want to consider having on your team is a broker or M&A intermediary. Business brokers operate a lot like real estate agents. They take a known single entity and they list it for sale, and they provide advice during the sale, and they help determine an asking price and so forth. M&A intermediaries generally deal with somewhat larger companies where there may be more issues, more assets, more rights, more contractual obligations and responsibilities and opportunities than you would find in a typical, one location, one type of business. Either way, those guys have experience doing dozens and dozens of deals. They know the process forward and back. They know where objections come up. They know how to counter objections. They know how to reach out to find businesses to buy. They know how to reach out to find buyers for businesses. And they have channels for doing just that. We'll talk about some of them in a minute. So you may decide that it's too expensive. I mean, these guys cost between 6 and 10% of the deal value. But at the same time, if it gets you 15 or 20% more in the selling price, hey, that could be worth it, right? Finally, buyers need a financing source, because I know very, very few buyers who can just walk up with their own money and plunk it down on the table. I don't necessarily recommend that either. And sellers are going to need a financial planner. You're about to come into more money than you've seen in one place in your entire life. What are you going to do with it? How are you going to use it for good? How are you going to use it to support yourself? How are you going to use it? What are your goals and objectives for that money? And a financial planner is the kind of person that can lead you through the process to help you do that. Then we go looking. We go looking for a business to buy, or we go looking for a seller, or we go looking for a buyer to buy the business. Where to go? First of all, a broker or intermediary is a handy place to start. They have contacts, connections, and networks that may enable you to reach across state lines or industry lines to understand what's out there. If you're interested in a particular industry, that industry's trade association and its publications sometimes will have classified sections that will advertise businesses for sale. That's one place to find them. Referrals, family, friends, fools, lawyers, accountants, you name it. If you make them, your network, aware that you're looking for a business of a particular type or kind, sometimes they'll pop one up. Newspaper ads. The Wall Street Journal, for example, on Wednesdays typically has a business opportunities section in it. I don't know if it's still Wednesdays. It's been a while since I looked at it. But that contains little box ads, about literally an inch type ad, that advertise businesses for sale. And they'll typically have the industry, the general area of the country, the general revenue level, and they'll have a reply email these days. And if you're selling a business, that can be an interesting way to generate leads. They're not qualified leads. They're just out of the blue leads, but they're leads. And if you're selling a business, the more leads you have, the better. because you'll have a larger group of buyers, some of whom will eventually come to want to be bidding for your business. Okay. You can look and search businesses for sale, or you can search buyers for businesses on the internet through Google. You'll get millions of hits. Then the challenge is winnowing it down into what seems like a reasonable number of leads to pursue. Finally, don't forget competitors. If you're selling a business, your competitors may be the best buyer of your business. Now, that's fraught with some connotations. You might have a cordial relationship with your competitors. You might not. That's one thing to consider. You also might want to be very careful about how you approach a competitor, because that could result in them doing anti-competitive things, telling your clients that you're going out of business or telling your clients that you're selling out before you want that known. However, if you use a broker or intermediary, that can all be handled on a blind basis and developed a little bit down the road until it's time for a non-disclosure agreement or a confidentiality agreement that that will protect both of your interests during the sale process. I see we have a question here. The few times I've tried to help a customer sell a business, the business brokers we talked with said the business was too small. Do you know the range business brokers tend to work with? Business brokers want to work with businesses that will generate a good commission for them. And if you think about the 6 to 10% number, a business that's worth $100,000 might generate a $6,000 to $10,000 commission. Now, what makes a business worth $100,000? That would be 4 times, for example, 3 times. That would be 3 times a business that generates $33,000 worth of cash flow a year. Cash flow, free cash flow, beyond what it takes to operate the business. We'll talk about valuation a little later. So if your turnover is much below that, I can see a business broker saying, no, that's not worth my time. Business brokers love to work with businesses that value out at around $1 million, because then their 6 to 10% commission is $60,000 to $100,000. Now, it takes 3 or 4 months to earn that, because the business process, the acquisition or sale process, will take 3 or 4 months. So they're going to be more interested in that kind of thing, larger numbers. As to a specific range, no, I don't have a specific range. It will depend on the broker, the market, the industry, if he's an industry-specific broker, and so forth. So those are the kinds of considerations you have to figure in there. If the business broker doesn't want to take on the business, you might ask them if they would agree to a consulting arrangement where they would consult with you without actually taking on the responsibility for generating buyers. And some of them will do that, some of them won't. Depends on how busy they are. So I hope that answers your question, Brian, and feel free to follow up if not. Let's see, where are we going here? We're going to change the slide if we can find a way to do that. There we go. Some internet sites where you can look for business brokers and others, or where businesses might be listed. Brokerage companies, the specific name of the brokerage company, their website. IBBA is the International Business Brokers Association, ibba.org. You can find brokers and businesses for sale that way. MA Source, mergeracquisitionsource.org. BizBuySell.com tends to have smaller businesses on it for sale. FirstList.com, same thing. Dealstream.com, same idea. There's a number of different places where businesses will be listed for sale, depending on how successful the website is in convincing that lister that their site is the place they should be. Now, confidentiality. Sellers' major concerns tend to be that, quote, word gets around. The rumor will get around that I'm selling my business, and therefore a competitor will steal my business by poaching my customers. They could be afraid of competitor reactions. Again, see the first 2 items. You can sort of forestall some of that with varying degrees of a confidentiality agreement that's signed between the principals. So if you find a buyer who seems credible on the surface, you might agree to a confidentiality agreement with that person where each of you agrees that you're only sharing information for the purposes of investigating a deal, and neither of you is going to use any of the other person's information for any other purpose at all. All right, whether to do or not do a deal, whether to start a competing business, whether to tell people about the buyer's lack of, in your mind, lack of seriousness about buying, and so forth and so on. Those confidentiality agreements range from simple 3-paragraph non-disclosure agreements to multi-page lawyer-drafted things that really do have some teeth in them. So keep that in mind. Now, we talked about intermediaries before, going it alone versus using an intermediary. The biggest thing for both buyers and sellers is that with an intermediary, initial contacts between buyers and sellers can be anonymous. The intermediary is representing to the buyer or to the seller on behalf of the other party without any disclosure of who the other party is. Intermediaries have experience in preparation and process. They know the process. They know what's necessary to have available. They have resources and networks to come up with additional help, which may be necessary during the process. They have ideas and experience with what has been acceptable in terms of structuring transactions, in terms of general negotiating strategies and negotiating points and tips and skills. They have their finger on market conditions. They also can help you save time. As a buyer, you might be evaluating several different opportunities. As a seller, you need to operate your business. You can't take 100% of your time away from your business to investigate and get a deal done. All right. And that's one of the biggest reasons for sellers using an intermediary is there's someone to backstop you. There's someone that's doing this process, that's continuing to pursue a task list while you're busy keeping your customers and getting new customers. Intermediaries also tend to take emotions out of the process. They also have skill and experience, in many cases, in estimating value. If you as a seller think your business is worth $1 million and your intermediary says, well, I kind of think it's worth about 100,000, you know that you've got some conversation to have about whether you're being realistic as a seller. As a buyer, if you have $20,000 in equity to contribute to a business and you want to buy a business that's valued at $1 million, now you need to have some conversation about whether you're being realistic or not. All right. For buyers, intermediaries often have access to or introductory capabilities to introduce you to financing organizations that may not be the traditional bank. And we'll talk a little bit about that later. For sellers, the intermediary can serve as an anonymizer and somebody who's anonymous who can approach your competition in the line of, we're aware that there is a company in your industry doing business in this general geographic region. Are you interested in discussing a potential purchase of that business? That's all that the start is. That's all the start is. Okay. And you don't disclose who the seller is until you've got some sort of non-disclosure or confidentiality agreement in place. Now, what's it worth? This is one of the key things that everybody asks, and it's one of the things that's hardest to assess. There are a number of reasons for doing a formal valuation of a business. We're going to talk mostly about the mergers and acquisitions side of it here today, but there's also partnership and investor entry, who's contributing what, and who gets what percent of the business as a result. And there's breakups. I hate you. You're terrible. Now leave. All right. That partnership investor breakup may be valued. You need to value what's being broken up. And so you sometimes may need an independent valuation professional to help you do that. Startup financing and planning. If you're looking for angel investors for your business, well, what's that angel investment worth as a portion of your business? All right. The guy who founded Digital Equipment Corporation ended up financing it out to a whole bunch of venture capital people, and he only wound up with 2 or 3% of the company at the end when it was a successful operating company. It made him mildly rich, but 70% of it would have made him seriously rich. You also might do a valuation for divorce purposes. Those are tricky to do. The first check you receive for a fee is often your last. The IRS requires a professional valuation to value non-traded businesses that are included in estate returns, estate tax returns. And that's a large portion of the valuation industry these days. Similarly, you might do a valuation for insurance or estate planning purposes where the business is going to enter into, say, carrying key man insurance on one of the major owners so that the business isn't crippled by paying the value that that person's estate has out to a spouse or somebody like that. Okay. Those are all valid reasons. Now you can add your own down there. That's what the dotted line is for in the bottom. Now there's some axioms about this. When buyers are buying, they're buying the future, but they pay for the past cash flow of the business. Sellers explain the past cash flow of the business, but they're really selling the future, what the buyer can do. And it occurred to me one day that it's worth to you what they've made of a business if you're the buyer. It's worth to them, the seller, what you can make of it. And in between those two is something we call price. It lies between those 2 points. And that's where negotiation happens. Now, there is a benchmark for sale and purchase valuations, and that's called fair market value. And this is a construct that says the fair market value is the amount at which the property would change hands between a willing seller, a willing buyer, neither of them is being forced to do this, and when both of them have reasonable knowledge of the relevant facts. Now already you can see how this breaks down when you start talking about a specific buyer and a specific seller, because one or the other of them might have a compulsion to sell or a compulsion to buy. I got to do this. I got to get out of here. I got to get my own business. Or a buyer who says, okay, I've got stage 4 pancreatic cancer and I need to sell this business. All right. So there's immediately some motivating factor other than just fair-minded, fair-handedness. And also when both have reasonable knowledge of the relevant facts. A buyer may know something the seller doesn't, like a property that's going to be very, very valuable because of a major expansion of one of its suppliers or one of its vendors, one of its customers in the area. A seller may have relevant knowledge of something that may happen in the next year or two that's going to affect the business dramatically. The two don't necessarily have the same knowledge base. But fair market value does give us a benchmark. We can start here and then say, okay, here's the fair market value. Let's talk about the specifics of this business, how it's different from that mythical fair market value benchmark. The price actually negotiated may be higher or lower. You determine the value, but then you negotiate the actual price. The considerations in determining fair market value rest on the business's operating cash flows. All right, those operating cash flows, less any capital expenditures, less any debt service, less any required dividends to family, friends, and fools who may be expecting dividends. All right, that's the principal determinant in most cases. However, there could be tangible assets in the business that are being underutilized. They may contribute value above the cash flow value. Comparable sales of similar businesses in the market you're in or in other markets, or in the industry you're in or in other industries. Those are also factors that a valuation professional will consider. Replacement value. What would it cost to replace this business? What would you have to spend to make this business be what it is now? Okay. And that's often difficult to do because if a business has been in business for quite a few years, you have customer reputation, you have intangibles, the value of the assembled workforce and experience. And what does it cost to put that together? Replacement value isn't normally used very much in determining a business, an operating business fair market value. You also want to consider the market segment that you're in and how it's doing, the reputation of the business. You have to determine whether there are any territorial rights granted by some group, organization, vendor, customer, whatever. And you finally have to talk about conditions in the economy, the larger economy that you operate in. In our case, it's the Southwestern regional economy, and then the larger United States economy. both those conditions as they are now and as they're forecast to happen over the next year or so. So you really come down to two items: the assets of the business and any income stream or cash flow, and that's the more important factor. All right. Now, also involved in the business is the business buyer's desire for a return on their investment. What is that desire and how is it expressed? Because that return on investment factored into the cash flow is going to give you a number that says, if I was just investing my money at this rate of return, what would be my expectation? What would I have to invest to get this discretionary cash flow? All right. Now, there's some terminology we want to talk about. Net income is income the way the accountants count it, income according to generally accepted accounting principles. That includes things like interest and taxes and depreciation, which is a non-cash charge, usually because of capital expenditures in previous periods, and amortization, which is its own little variant of depreciation when it's applied to intangible assets. The seller's discretionary cash flow is the cash flow the business doesn't need to operate, that the seller decides what they can do with. All right. Now, to get there, we start with a construct that's taken from accounting, but it takes out a few things that are in a normal accounting profitability statement. And this is called earnings before interest, taxes, depreciation, and amortization, or Ebitda. And you'll hear people talk about Ebitda, and they're referring to it as a proxy for the operating cash flow of the business. This doesn't take into account timing differences in payables and receivables payments, nothing like that, nothing affecting the balance sheet. It's strictly based off of the income statement. And as I said, investment analysts that are analyzing publicly traded companies will use Ebitda as a shorthand way to get to the business's operating cash flow. Here's an example. If I look at Ebitda, my net income is $100,000 in both cases, and I've got the same numbers in both cases down to the Ebitda level. I've got $160,000 in Ebitda in both cases. Now, beyond that, if the owner takes out their own salary for 65 grand, they've got health insurance they're paying 10 grand on for them personally, not for the workforce. And then they've got their own automobile that the business is paying for to 8,000, and say, well, maybe they're a pilot. They've got their own airplane paid for through the business. Okay. Those items get added back to Ebitda because they're presumably buried in the financial statements of the business. And all of a sudden, instead of $160,000 of seller's discretionary cash flow, as a seller, you're offering a cash flow of $283,000. Now, buyers, there's two things on this list that you want to be careful about. As a buyer, you want to be an investor buyer in the business. And that means that the business's cash flow has to reflect the fact that there's a manager's salary worth of labor being taken out by the manager. If you're the buyer and you're going to be the manager, then that's your salary, okay? Whatever that number is. Similar thing with immediate benefits like health insurance, all right? But the choice to have an automobile paid for by the business or an aircraft paid for by the business is an individual choice, and those items are properly added back when you see them as a buyer, added back to Ebitda, okay? And if they're not added back to Ebitda, you should be adding them back to Ebitda to adjust what you're going to offer for the business. And then you have to remember the reason that you're not adding back the owner's salary and the owner's health insurance, if the owner is the business manager, is that you are an investor buyer and you don't want to be buying yourself a job. All right. $75,000 of cash flow, which is the sum of those first two numbers there, times, say, a multiple of 3, means you're paying $225,000 for that cash flow, which just buys you groceries. You're buying yourself a job. And I tell sellers to expect an offer that reflects that adjustment. And I tell buyers to make sure they make that adjustment when they offer. That's negotiations. The basic valuation formula is earnings times a multiple. Sorry, I got that out of order. The lower the multiple, the lower the price. And that lower multiple reflects things like a higher business risk or lower growth or synergy potential with an existing business. It also reflects the fact that debt capital may not be readily available to a business. Cannabis businesses are going to have relatively low multiples of earnings, although their earnings might be pretty good, because for the most part, it's very difficult to get any kind of debt capital financing for a business that deals with something that is still federally illegal. Oh well. Higher multiples in business reflect lower business risks. You're not growing and selling cannabis, you're growing and selling tomatoes, for example. Or it reflects higher growth and synergy potential as viewed by the buyer. Or it's a business for which debt capital is readily available. Debt capital being available means you can borrow money at a lower cost than equity costs you. Equity is the most expensive form of capital because people's expectations of return on investment are very much higher than in a bank. A bank might want a 5 or 6% return on its investment. You as a buyer ought to be wanting somewhere between 25 and 50%. And we'll talk about why that is in a minute. So you have earnings times a multiple to get to a value. The valuation process is what determines the earnings base, evaluates the business risk, and determines the earnings multiple. Those earnings can be defined, as we just saw, in several different ways, and you want to know the difference between them or among them, the differences among them when you look at valuation. Now, there are industry rules of thumb for just about every industry. And a rule of thumb is just something that's applied to some obvious portion of the business, whether it's the gross revenue or the seller's discretionary cash flow, to get you a value, okay? Like when you say accounting practices should sell for 1 times annual revenue. It's a multiple of 1 and annual earnings of, or annual revenue of X, all right? That's a rule of thumb. Now, whether that applies to every accounting practice is not true, because every accounting practice has slightly different issues, slightly different clientele, slightly different focuses of business, slightly different profitability. All right. You could also have a rule of thumb that says it's a multiple of seller's discretionary cash flow. All right. That's at least a place to start. And it's based on somebody having done some work sometime in the past on that industry. However, those rules of thumb can be misleading and inaccurate. You can use them as a ballpark, but don't use them to negotiate a specific price. Now, valuation specialists are additional to brokers and intermediaries. They're people who come in who have a specialty in this business. They've acquired credentials in the valuation field. They can offer their opinion. In our opinion, this business is worth X or Y. They're independent, they're objective, they're subject to the same kinds of standards that CPA professionals or legal professionals are subject to, and they are in a third party to assist you in understanding what the fair market value might be for the deal, or to assist you in understanding what the value might be under rules that you give the professional to work with. Look for credentialed professionals if you're going to find one. CPA/ABV is a credential. ABV means accredited in business valuation. CVA is certified valuation analyst. CBA is certified business appraiser. ASA is accredited senior appraiser / business valuation. Those are all granted by different organizations, from the American Institute of CPAs to the American Society of Appraisers, or the National Association of Certified Valuation Analysts, or NACVA. All right. There's probably more NACVA people around than CPA ABVs or ASA ABVs, but they've all taken specific knowledge courses, and they've all passed a specific knowledge test, and they've all evidenced some experience, at least, in performing independent objective valuations. Now, these valuation specialists can be expensive, so defining the scope of work is critical. Most of the standards that apply in each of their various organizations allow you to specify something less than a full fair market value opinion of value. they can undertake specified procedures for you that give you a better idea of what the business could be worth without having to spend money on a whole full opinion audit that they'd be ready to go to court and defend if you wanted them to. Okay, those are expensive. Now, recognize that if you're the buyer and you want to value the business that you're interested in, the cooperation of your proposed target may be necessary for a valuation specialist to get the full picture. All right, and the full picture does involve a good deal of work. So one of the things you get done when you get done with your valuation is you want to test it for reasonableness. And the question that tests is, will the operating cash flow satisfy all the various claim holders to it? Excuse me. For example, you want to satisfy Uncle Sam for income taxes. You want to satisfy the lender for debt service. You want to satisfy the company as far as its need for capital expenditures to continue its productivity, and working capital as it expands. You need more working capital to have more inventory on hand, more working capital to have a bigger receivables base from your customers. All right, all those things are important. And in addition, you want to satisfy your equity investor return on investment requirement, whatever that is. Okay, if your equity investor requires a return on investment of 25% and the business produces $100,000 of cash flow, will it produce $25,000? Will there be $25,000 left for the equity investor after you pay debt service to the lender, income taxes to Uncle Sam, and capital expenditure and working capital reinvested in the company? If it won't do that, are you as an investor willing to accept a lower ROI? Or are you going to move on to a different deal? Or are you going to try and find a way to reduce any of the upper three claimants? All right. So that's a test to apply once you've figured out what the operating cash flow is and who's going to have a claim on it. Now, we'll talk just very quickly, a fair deal versus the best deal. The actual selling price of the business is the price the two of you as buyer and seller agree on. Okay, that's a fair deal. It will probably not be the best deal for either the buyer or the seller, because the give and take in negotiations that you have between the buyer and the seller is what ultimately results in a deal. If both you, the buyer, and you, the seller, are a little bit unhappy with the deal, a little bit, not a lot, a little bit, you've probably reached a reasonable deal. But that's both of you, okay? There are very few bargains in buying business. There are very few windfalls in selling businesses. You can hear about them. There are examples. They happen, but don't count on it. Now, tax structuring, just briefly. The biggest tax structure consideration in a deal is whether it's going to be a stock sale, and that's the capital shares of the company being sold, or whether it's going to be an asset sale where the company sells all of its tangible and intangible assets, and then the seller winds up the shell that's left. All right. And that has to do whether you pay income taxes at capital gains rates or at ordinary income rates. On an asset sale, the seller may pay more taxes when they sell assets. That's because the depreciation and amortization that's been taken will have to be recovered at ordinary income tax rates, because that's what it was deducted at. The buyer gets the opportunity for some tax advantages by revaluing the assets that get bought in an asset sale at a new fair market value. The seller gets the chance to defer a recognition of gain and a recognition of tax if there's an installment sale, which means they hold some paper for a period of time or get paid over time for certain things. There's also an interest income or expense aspect to this, that's income at ordinary income tax rates or a deduction at ordinary interest deduction rates on both sides. Those are tax considerations, and that's why you have a CPA on the team. Okay, very important. Now, there are several different ways you can own a business. You can own a business as a traditional, ordinary, everyday corporation, which is called a C corporation. You can own a business as a corporation which passes through its income to its shareholders. That's called an S corp. There's a limited liability company, or LLC, which is another way of having a corporate form of organization, which still passes taxes through. It's kind of like a corporate partnership, which could have only a single owner if you wanted it to. And finally, there's the sole proprietorship. It's beyond my scope to talk about the pros and cons of those here. Suffice it to recognize that there are pros and cons, and you want to discuss those pros and cons with your accountant and your attorney in doing a deal. Now, financing. Buyers, you're going to be interested in this. First of all, you want to consider where your sources come from. Financing options include conventional everyday bank financing with an SBA guarantee, or a direct loan from the SBA. There are a couple of programs like that. You're going to want to consider seller carryback notes. In other words, the seller holds financing for part of the purchase price. Say we've got $1 million deal, the bank's going to hold 70% of the deal. The seller is going to, the buyer has 20% to put down in equity. That's 90%. That means the seller holds 10% in financing. Those notes are subordinated to any bank debt. They typically carry a slightly higher interest rate than the bank debt, or not, depending on the negotiation. And they typically get paid off in a fairly short period of time, anywhere from 3 to 5 years. Could be 1 year too. It could be 7. But that's the 3 to 5 years is kind of a range. The buyer has to come up with his part of the deal, or her part of the deal, from personal savings, from the equity in their house. They could take a home equity loan. They could raise money from family, friends, and fools who want to invest in their business, who believe in them. And finally, what I don't recommend is you can take a retirement plan under certain circumstances and invest the money in the retirement plan in the capital stock of a privately traded or privately held corporation. That requires both tax and legal advice. And I also tell people, don't do it. The reason I tell people not to do it is because that retirement plan is your retirement period. You've earned it, you've developed it, you've banked it, okay? And if this deal doesn't work out, where is it going to leave you? So keep in mind that although that is a source, and it is possible to do in some cases, you need very, very professional advice as to how to do it. And secondarily, you need to recognize that you're staking your entire life savings or retirement account on this deal. So make sure your confidence is not misplaced. Now, conventional bank loans will typically lend you 50 to 70% of the value of equipment. They'll lend you 25 to 50% of the value of inventory, especially if it's raw material inventory. They'll lend you between 50 and 80% of the value of receivables, depending on how good they are and how old they are. That has to do with the credit rating of your customers and whether your customers pay on time or not. They typically won't lend you money against the intangibles unless the intangible is something like a specific, very useful patent. Bank loans will have short to medium terms. Inventory and receivables typically will be financed on what's called a revolving credit line that's renewable every 5 years or so. Equipment will be typically on equipment loans that tend to run in like a 7-year time frame or so, and have fixed payments of principal and interest. They'll be short to medium terms. They'll have a higher down payment in terms that the bank will want more up front, which means they say they'll lend less against the equipment. If they'll lend you 70% of the appraised value of the equipment in the deal, well, you still got to come up with a 30% somehow elsewise, right? SBA loan advantages include longer terms than conventional financing. So that can be up to 25 years for real estate financing, up to 10 years for an acquisition loan, and they do acquisition loans. That will result often in a lower down payment for an SBA guaranteed borrower. The SBA has a couple of programs that do these loans directly, and I refer you to the SBA office in Albuquerque for more information on that topic. The SBA loan program qualifications include some qualifying criteria. They want the owner equity or initial investment to be at least 10%, but it could be as little as 10%. The owner has to be actively involved in daily operations as the owner manager of the business. They need previous business or industry experience. There needs to be satisfactory credit history. The cash flow has to meet the proposed debt service coverage ratio, and the debt to net worth has to be in line with industry standards. All of those are looked at by underwriters on the SBA side. They're looked at by underwriters on the bank side. If it's an SBA guarantee deal, it will be done through a bank. Now, cash flow lending is lending that's based on the Ebitda of the business. And it looks at a number of factors, they're listed there in your slide, that begin off of net income and Ebitda. And the bank wants to be sure that the debt service coverage, that's the principal and interest payments combined, compared to the net income, is no more than some fairly modest percentage of income. They might phrase it this way. The debt service coverage needs to be 3 times income, which means that the debt service can't be more than 33% of the income as they define it. Okay? And a really conservative bank might want 4 times coverage, or a little less than 33% maybe. But usually it's in that 2.5 to 3.5 kind of range. We have a couple of questions here. Let me try and deal with them. Answer live.
Tommy, there's one in the chat too. That one's been there.
One in the chat. Okay, I'll take that one next.
Okay.
Do the credited professionals in your list tend to specialize in certain industries? There are valuation professionals who have broad experience in an industry. You're more likely to find valuation professionals who have broad experience across a number of industries, rather than one who specializes in one industry. There are consulting firms who do feasibility studies for certain kinds of business activities and operations, and there are those who specialize in one industry. For example, there's one that specializes in assisted living facilities, and there's another one that specializes in hotels. I think that's Towers Perrin, maybe that one, or Foster Associates, I forget which. So if you're in a specific industry, you can Google and find out, is there an accredited valuation professional or an accredited broker intermediary for this industry, and see what you get back on that. How hard is it to get loans for delivery routes, asks Marcus. Marcus, it's hard, because the delivery route you purchase from somebody needs to have some sort of territorial rights attached to it, so that you have a legal right to be delivering that product on that route to the exclusion of everybody else. Now, if you have that, I would be suggesting that you approach what are called non-bank lenders. And I need to add a slide in here on non-bank lenders. Those are organizations that specialize usually in very much smaller than normal loans to individual borrowers for small business activities. You make a note of this. In the Albuquerque area, 2 such non-bank lenders are operating that I'm aware of. One is called The Loan Fund, and the other is called, it was called Axion, and now it's called Dealstream?
Dreamstream.
Dreamstreet. And look, you can look those up and look at their requirements and and talk to them and their officers. That's not something a conventional bank would normally do, but a non-bank lender might consider it. And over here in the chat, we had a question. What are the smallest and largest businesses you helped buy and sell? Okay. The smallest business I helped buy was about it wound up being around $800,000 or $1 million, depending on what value you gave the inventory. I was director of mergers and acquisitions for a $120 million manufacturing company. And we did 8 transactions buying and selling in about a 4-year period in the 80s. This smallest one was roughly, like I said, about $600,000 or $800,000, $800,000, $900,000. And it was a very small lawnmower manufacturer in Ohio. The largest one was we bought the Bolins Corporation, which is located in Port Washington, Wisconsin, or was. And that deal overall was about a $6 million equity deal. Now, there was a lot more debt in the deal. I mean, it was Bolins Corporation had about $60 or $65 million in revenue, if you're judging them by that size. Later on in the small investment bank that I worked with, we sold a tourist attraction to new owners. In the end of the process, 2 existing shareholders bought out the other 223 shareholders. There were 231 shareholders in this business, and it was $3 million a year revenue, which seems a little odd. It had been in business for 60 or 70 years, and the shares of stock had been split down through various inheritances, and that's how it got that many shareholders. So yeah, I'm in that range. The investment bank that I worked with before I retired had done deals. I wasn't part of the deal team for those deals. Had done deals totaling about $1 billion, $1.5 billion. The largest of which was about $900 million, and the smallest of which was our roughly $3 million deal. And that's about what the deal equity value was about $3 million. So there's that. That takes care of the chat. And we can move on now, hoping to wind this up pretty quickly. Your copy of the slides will contain this slide, which is adjustments to Ebitda that happen in the course of negotiating a value for the deal. There are some possible add backs to Ebitda. For example, if you have major non-recurring expenses, things you know aren't going to happen again, it might be appropriate to add those back to get an adjusted Ebitda that more accurately reflects the true operating cash flow. Those things include large one-time legal bills. They include family member salaries if those salaries aren't going to continue. In other words, if the family members are going to leave as a result of the deal, but you still have to replace the bodies, that wouldn't be an appropriate add back. But if the seller had his 9-year-old and 10-year-old on the payroll as a way of building up their college funds, then that's a reasonable add back. Employee pension plans, depending on whether or not you're planning to continue it or modify it or otherwise deal with it. One-time consulting fees, major marketing productions that aren't planned to recur, such as a big product introduction at one time. If you decide to do that in the future for another product, that's on you and your operation of the business. Unlikely add backs include things like communications expense, auto expense. Owner's insurance may be added back only if it's in excess of what a normal manager would be granted as far as insurance goes. Adjustments to cost of goods sale, be very skeptical of those. Reductions in personnel that the seller is claiming you can do, be very skeptical of those. And don't cut back on trade conferences, associations, and dues or anything like that, or allow them to be added back, because those are very important things to have for the business to stay current with industry developments. All right. So if they're trying to add some of that stuff back, you're not going to let them, or your offer is going to reflect the fact that you haven't added that back. Same principles with valuations. Some of them improve the Ebitda, some of them don't. And you want to be careful that it makes sense, that your adjustments to financial statements and Ebitda make sense going forward, and that the resulting changes in value make sense from the standpoint of the business. Now, you're going to have an information exchange at some point, usually after a more complete confidentiality agreement is signed. The seller will turn over their information, their detailed information, tax returns and financial statements for 3 years and the current year to the last quarter, or even the last month that you have available. The buyer will turn over a complete loan application to the bank. He'll turn over personal tax returns for 3 years. Usually the bank gets to see those. The buyer and the seller will collaborate to produce a purchase agreement with an allocation of the purchase price. This is where the lawyers get involved. in terms of protecting each side's interests. The CPA gets involved with the allocation of purchase price. The buyer might also turn over business tax returns and financial statements if they own other businesses. That's by way of convincing the seller that they're capable of operating this business and that they have the value and the infrastructure that's capable of operating it. Other things by way of initial due diligence is copies of AR and accounts receivable and accounts payable aging reports, equipment lists, copies of existing lease agreements, copies of W-2s for year end, for the previous year end or the previous period for the workforce, and then detailed evidence of any and all add backs to Ebitda and why those are properly added back. Here's where your CPA comes in to review all this stuff and provide you with their thoughts about whether it's really a good idea or not. Any other needed due diligence documents come into this as well. This is a due diligence period once you've negotiated the business deal. And that business deal is negotiated through what's known as a letter of intent. The letter of intent can be drafted by yourself, or it could be drafted by one of your representatives, whether a lawyer or an intermediary. I recommend intermediaries to draft these, not lawyers, because they get lawyerly. It removes the emotional attachment and emotional and individual motivations from the deal. You're recounting the market content, the market conditions, and the absolute business deal in your LOI content. The LOI sets forth the deal. I'm going to pay you this much for your business. The deal structure, here's how we're going to do this deal, assets or stock. It sets forth the price and the terms. I'm going to pay you X amount at closing, Y amount monthly for Z number of months after the deal. There'll be a consulting agreement for you and a non-compete agreement for you, both of which values will be part of the deal price. There'll be a no shop provision, which will be binding. And there'll be a confidentiality agreement, which will be binding. And any other key negotiated items will be recounted in the LOI. Now, the LOI is not the definitive deal agreement. That's only the actual purchase and sale agreement. But what this does is it sets both the buyer and seller forth on their seriousness of intent to do the deal. Okay? And the only things that are binding in it typically are the no shop provision and the confidentiality provision, right? No shop means that once the seller signs it, the seller agrees not to sell the business to anybody else or to shop it around to anybody else or to advertise it to anybody else for some period of time. Usually that's 90 to 180 days. And that's negotiated too, okay? Deal structure, all the things that are on there. Consulting agreements and non-compete provisions are ways for the buyer to turn part of the purchase price into tax deductible expenses, because the payments under those provisions are ordinary income to the seller and ordinary expenses, business expenses, deductible to the buyer. If there's an earnout involved, that will be specified in the LOI. Any indemnifications typically are saved to the purchase and sale agreement. There'll also be, the purchase and sale agreement will also have agreement clauses concerning transitions and training, the amount of time the buyer is expected to spend in a transition of the business, introducing the new owner to customers, introducing the new owner to vendors, introducing and training the new owner in how specific business processes might work so he can effectively supervise the people doing it. And it will set forth the expected timing for the deal. Due diligence I've talked about a little bit. It goes both ways. The seller does due diligence on the buyer to verify that they've got the financial resources to get the deal done. They've got the financing lined up. The buyer does due diligence on the seller to get proof that they actually own the assets they're selling and that they have good authority to sell them. Here's where good preparation comes in, because if everything's in line, all of this can get done quite quickly. Okay? You have 3 different areas to do due diligence in: legal areas, operational areas, and financial areas. You want to verify the assets as much as you can: real estate deeds and leases, equipment titles and invoices, inventory invoices, and so forth. Your intangible assets are patents, trademarks, logos, and so forth. They should all be evidenced by registration with the appropriate authorities, or well accepted usage that's been developed over a period of time. Buyer due diligence happens operationally. You need to talk to key staff, and the seller has to agree to let you do that. You have to assess the organization and its capabilities, the products and services and their attractiveness, the processes in use and their technological stage, the technologies that are in use within the business, the asset condition. Is that Bridgeport mill spanking brand new, or is it 55 years old that's never been overhauled? You also have to assess competition. What's likely competitive effect, who the biggest competitors are, what they could do to disrupt your business, what you can do to disrupt their business, and so forth. Your lawyer will come in and look at asset title transfers and assignments, creditor approvals, regulatory and tax clearances, all of that stuff. Your lawyer will handle. Your accountant will come in and look at the price and terms, conduct that reasonable test for does the cash flow meet the proposed deal structure demands on it. Tax structure, tax opinions, third-party financing, third-party appraisals, purchase price allocation. You'll get involved in all that too as the buyer or seller, but your CPA is going to provide advice along the way. You're also going to define in the purchase document, you'll define who's responsible for whose fees and expenses. And typically in these deals, each side pays their own representative. Okay, that's the commonest thing that happens. But there could be deals where you agree to pay the buyer's expenses just because you want the business so badly, or because the buyer has issues of one kind or another that prevent them from really wanting to do that. Again, it's negotiated. Non-financial due diligence includes things like determining the business's market position and reputation, looking at management agreements with key employees other than the owner. You may want to put those in place prior to a closing. You want to verify that customer-vendor relationships or franchise rights will transfer. And the key questions for the buyer to answer in this process is, can you do or learn to do what the business does? And then, can you improve the business? Because you're only really going to make money off the business if you can improve what it does. Otherwise, you'll just get what you paid out there in the long future day away when you decide that it's up to you to sell the business now. Finally, closing. Closing is the deal table. This is where the legal deal gets negotiated and signed. And yes, there is negotiation between the LOI and the purchase and sale agreement, because the lawyers are involved here in protecting your interests, and they're going to go back and forth and present you with choices and conflicts sometimes, and you'll have to make choices on to get the legal deal done. You're going to want to choose what entity you're going to buy the business into and create it. You're going to want to register that entity for employer identification numbers, gross receipts tax, workers' comp, insurances, and every other form of business license that you might need to operate the business. Your CPA is going to set up a chart of accounts and new books for that new entity so you can start right from day one. You're going to make sure your banking relationships are in place and that they transfer to the new business. Similarly with business insurance, similarly with payroll processing. And then finally, there's usually a date. If the business involves inventory, there's usually a date at which a final inventory count is made and an inventory valuation is done, and a comparison of that to the purchase price allocation for inventory is made, and there's an adjustment up or down based on the change in the inventory value. That's a typical thing in a purchase and sale agreement. Contracts. Once the purchase and sale agreement is signed, it will have conditions precedent to closing, and both sides have to fulfill all those conditions. It may be that you have to involve an escrow agent or an attorney to hold contracts or to hold monies pending the fulfillment of some of those conditions. And this is where the lawyers get in there again, because of their experience. It's details, 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 details. When the company I was working for in the 80s bought Boland's Corporation, my pre-closing checklist, task list document was about 15 pages long. And it included tasks that had to be done by both parties, specific people in both businesses, before we could get closed. And the last task was sign the documents, close. And that closing process took an entire morning because of the number of different agreements that needed to be signed, the number of different side agreements that there were to those, the number of affirmations, the number of declarations, the number of tax opinions, and this, that, and the other thing. It just took time. That was a fairly large business, but still be prepared that closing is not just a show up 10 minutes in the office and you're done. Post-closing, you as the buyer are going to want to true up your working capital. That's what I referred to partly as the inventory adjustment earlier, but also might involve truing up receivables in case that's a factor. Now, usually true ups are added or subtracted from any seller financing that's being held, and a new monthly amount is determined. Sellers and buyers, you're going to want to go through training and integration. If the business is being integrated with a larger business or a different business, there's assets and elements there to go into. You're going to want to collect revenue. You're going to want to pay the seller financing. You're going to want to monitor any earnouts that are involved. In other words, an earnout is when you say, I'll pay you X for your existing business, but if I do better, you'll get an earnout. You'll get a sweetener in the deal. Or I, as the seller, say, okay, you've offered me that much for the business, and I know it's based on this level. Yeah, I know it's based on this level, but if I do better, then I want a little more. If you do better, I want a little more. That's part of negotiation. And finally, you monitor the conditions in the purchase and sale agreement so that everybody stays on the up and up. You do things according to the deal. Mostly that has to do with the payments being made to the seller for the consulting contract, the non-compete agreement, and any seller financing notes that are held. So all that goes on related to the deal after closing. Now, I'll give you a moment here. I have one item in the chat menu. Brian needs to leave. Thanks for coming, Brian. We'll see you later. I'll give you a minute or two to ask any further questions that you may have as we've gone along here. I've tried to keep it as concise as I could. I am open to questions, and if you have questions that occur to you after you get the slide copies in a follow-up email from NMSBDC, please feel free to route them back to NMSBDC. They'll send them to me, and I'll send them back to you. I'll send you answers for all of those. If there aren't any immediate questions here at the end, I will say thank you very much. I very much appreciate your time and your effort in listening, because I had to crank up my listening speed a little bit. And I know here in New Mexico, people sometimes listen a little more slowly than I might talk. So you can go to nmsbdc.org for more training, business counseling, loan application assistance, as we said before. They also have links to a variety of other resources. And I do ask that you complete the survey you're going to get after this presentation. That helps me improve it, but your comments are very valuable in all respects. And we do a better job if we incorporate your feedback in future presentations. Finally, if you don't have anything else, I don't have anything else, and that's all, folks. I want to thank you for your time today. Chris, if you have any final comments, please chime in. And
I just wanted to thank you for your.
We'll look forward to the next presentation.
Thank you for your presentation. It's always fun. I will allow the attendees, since we have an intimate group, to raise their hands, but the last call for that. And if there's not anything else, I'll bid you a good day, everybody. Okay.
Thanks, everyone. Bye-bye now.
Bye-bye.